Thank you for joining us today. Let me begin by introducing our first speaker, Sahir Anand. Sahir directs Aberdeen Group's retail and hospitality research practice with an eye on technology-enabled strategy execution in 3 areas: retail and related industry, end-to-end value chain planning, and execution and analysis. His research is related to use and adoption of IT portfolio capabilities and processes that aid cost optimization and efficiencies. Thank you, Sahir, for joining us. I will hand the mic off to you.
Good morning, and thank you for joining Econom Retail webinar on inventory optimization strategies in this current recession, which is impacting all consumer-facing industries, but more so retail segment as well. The purpose of this webinar is to present some findings in qualitative as well as quantitative data that Aberdeen has analyzed over time, of course, the last 3 months, in really looking at the key challenges and pain points that retailers are facing in varied subsegments, including fashion apparel, general merchandise, and specialty, as well as some of the other key retail segments, including the grocery segment. And this presentation today is a culmination of about 150 survey respondents. The findings today that I'm going to be discussing are part of all the analysis that we've conducted in the US and abroad. So the agenda for today is the following. We're going to be covering inventory management structure today as it prevails in the retail industry. A self-evaluation criteria that we presented to retailers, and they responded back in terms of their inventory management processes as they stand today. The top business and technology priorities as it relates to the area of inventory optimization, merchandising, as well as assortment-related strategies that are prevailing in retail today. And finally, we come to the core methodology that Aberdeen follows, which is PACE. And let me take a second to explain how PACE works. PACE really stands for the 4-letter word with acronyms. There's no research without acronyms. So PACE is P for stands for the business pressures that retailers are facing today vis-a-vis their inventory management processes and technology adoption. The A in the PACE model is the strategic actions that companies are taking in order to alleviate the business pressures. The C in the PACE model are the capabilities, and as you might be well aware, there is no technology or business process in the space or any industry segment that can continue to derive the right kind of results for any company unless there are complementary and supplementary capabilities that support the technology or business process. And finally, the E in the PACE model are the enablers or the technology itself. So those technology components that support the inventory strategies in retail. So a typical inventory platform could comprise of several different components, and we'll be discussing some of these components in the upcoming slides. The last 2 areas that I'm going to be covering as part of my presentation today will include segment evaluation as well as the metrics that are required for retailers to be able to improve their year-over-year performance in terms of what they're investing in their day-to-day inventory and what's being sent to the stores, what's actually selling on the shelf, and then what results are they deriving out of that? Is it the return on net assets? Is it a positive year-over-year gross margin return on inventory? Is it a better inventory turn rate? So those are some of the metrics that we'll be discussing today. So let me start today's conversation by giving you a little bit of a historical backdrop as to what's been happening in the industry as far as some challenges that retailers are facing. And one of the core challenges is inventory. It's a tough market to be able to predict what the customer is actually seeking at the retail shelf. And the reason why the last 10 months have been more difficult in order to really predict the shelf level demand and how a retailer plans their assortment and their merchandising strategies is purely because of the fact that the consumer demand trend has been fluctuating. And it's been fluctuating not on a month-by-month basis or on a quarter-by-quarter basis, but on a day-to-day basis. And that's kind of unforeseen considering the last 5 years that retail has grown globally, and it's definitely a different environment where where companies have not been able to predict the demand. Consumer demand shifts have consistently occurred, and the typical inventory strategies, the typical tactics that retailers have adopted in the past, such as planning the inventory buying cycles 6 months in advance, planning the open-to-buy merchandise requirements and leaving them pretty flexible, planning high levels of safety stock. Those sort of typical tactics are not conducive for the current environment. So in terms of all our research, we present all our research in terms of what best-in-class companies are doing versus all others. And what this really means is that best-in-class, according to Aberdeen, are the top 20% of companies based on key performance metrics that we ask these companies to self-report on. So best-in-class are the top 20%, average are the middle 50%, and the laggard companies are the bottom 30%. And we rate best-in-class, average, and laggard companies based on their performance on key performance criteria related to the inventory metrics that I mentioned a little while back, which include inventory turn, inventory holding costs, the cost of goods sold, as well as the ability for a company to derive better GM ROI. So what our results show is that there is a definite divide in the industry today in terms of perpetual inventory strategies and the non-perpetual inventory strategies. What our results show is that best-in-class companies are almost twice as likely to have perpetual inventory strategies in place, which are really executed by cross-functional product teams. And that really ensures that there is a level of balance in terms of how perpetual inventory is looked at on a day-to-day basis, how it's being planned, how its visibility is increasing, and how it's being executed for warehouse and store level deployment. And the best-in-class companies do a fairly good job in really employing perpetual inventory techniques rather than non-perpetual inventory or static inventory techniques, which is something of a traditional trend in retail, which companies need to move out of. And what our results show is that in terms of perpetual inventory being managed in the industry today, the use of single owner of end-to-end inventory policies and procedures is also a best-in-class trend. And I think where the industry is truly headed today is, if you take the example of the grocery segment, the grocery segment is a classic example of a retail segment that is trying to overcome this legacy, traditional inventory, static inventory gap, and is trying to move towards perpetual inventory. It's a gradual movement, and I think more companies that move into a perpetual inventory strategy will streamline their return on investment. They'll also streamline their working capital requirements as they move forward. So the definite trend in the industry today, according to best-in-class results that Aberdeen has collected, is that perpetual inventory systems is the way to go in terms of the current environment. The next slide presents the self-evaluation criteria that I just mentioned, and it's interesting that best-in-class companies actually do fall into every category where they've outperformed the average and laggard companies in really being above average or just about average in terms of their inventory performance this year compared to last year.